What about modern activities for banks? So we will start with the definition of payment system. Payment system like Swift as the payment system, and in this case we talk about the transferring of money between participants in this system. Maybe participants, individuals, maybe corporates, maybe government, and so on. So in this case, we talk about the payment system. If there is any problem, if there any problem in the payment system, this may lead to failure for the bank and crisis for the bank. The cashless payment, when we talk about the payment without money, without physical money, we talk about virtual money. May be different based on the nature of country. For example, European Union, we talk about the checks or payment checks are the main method in UK and France, but for smart cards are the common in Germany and France and Netherlands. The payment services, when we talk about payment services, what about the main types of payments? Number one, check payment. This is the original method of payment services. And the check payments are written claims or debt transfer. Written claims by the account holder to transfer money or fund to the beneficiary. So in this case, we talk about the first type of payment, check payments. Some countries like Egypt tends to decrease the check payments. Method number two, credit transfer. Credit transfer or zero credit. In this case, we talk about payments by the account holder that the account holder as the individual or firm request their bank to transfer funds or money directly to the beneficiary. Okay, in this case we talk about maybe the individual pay in advance, maybe the individual or the account holder pay bills. Another type of payment when we talk about standing orders. Standing orders mainly instructions. Instructions provided by the account holder that request or instruct the bank to pay fixed amount of money at regular intervals or regular time or regular period into the beneficiary bank account. So in this case, maybe use standing, or if you want to modificate the standing orders, only the account holder can modificate this instruction, can change this instruction. The orders accepted by the bank from the account holder by email, by internet, by mobile. Direct debts. Direct debts created a relationship between the producer and the client. So in this case, the client agree the direct debt. In this case, talk about the agree from the client to transfer the direct debt. Direct debt, usually variable amount, and the times at which the debting place or taking place can also fixed or variable. But if the payment missed, if the payment is missed between the client and the producer, in this case, the producer can request, the producer can request the missed payment on the number of times. So in this case, we talk about examples for this debt. Maybe if the corporate or individual pay utility bills like electricity, like telephone, like gas, like water, in this case. Credit cards. Credit cards provide the bank account holder with a credit limit to use for purchases. Purchases may be retails, may be outlets, may be the stores. In this case, the retailer pays the credit card company a commission. Credit card company like MasterCard or Visa. In this case, every transaction created by the client, the retailer pay a commission. The next, if the bill is not fully paid off, the interest will add. So the interest add to the credit card till specific date. Till specific date. And this is the main source or the main tool for payment in developed countries. Prepaid credit, or we can describe as pay as you go. Pay as you go credit. In this case, we talk about step number one. You need to inject or feed your card with money. Number one, you need to inject or feed your card with money. And then you can purchase and use the card based on your injection, based on your injection or your money. So, unlike normal credit or debit cards, you buy only based on the amount of money you put on the card. So, why some individuals and corporates encourage pay as you go credit? Because it's simple steps, simple requirements for approval from the bank. Number two, available to clients with different income groups, mainly when we talk about poor credit history or new clients, or there is amount of money you can put 1000 Egyptian pound, for example, so you can use this 1000 in your purchasement. Debt cards, two types of debt cards. First, debt card, in this case, you can use the debt card by ATM to withdraw the cash, okay, or obtain the cash, and maybe your salary transferred into this debt card. The next type of debt card, delayed debt card. Delayed debt card, in this case, issued by the bank and allow the bank account holder to make purchases, yes, and withdraw money up to authorized limit. Up to authorized limit. Okay? Maybe this debt card or delayed debt card, the limit equal 30,000 of Egyptian pounds. So this is your limit. When your credibility increased and improved, in this case, you can increase this limit. And this any delay for the payment leads to extra fees. Travel and entertainment cards. Travel and entertainment cards. In this case, we talk about a specific type of cards we can call charge cards. What is the difference between travel and entertainment cards and delayed? In this case, the travel and entertainment cards, we talk about monthly transactions. Monthly transactions. So if you can purchase until the month greater than month, you will pay extra fees. You will pay extra interest. Memory. The popular charge cards when we talk about American Express and Diners Club. Memory chips cards. In this case, you will use the phone cards or prepaid phone cards to make transactions, purchasement. At the same time, in this case, we can talk about the mobile money and transfer money between chips. The second category of services, deposits. What about the categories of deposits? Number one, current or checking accounts. Current or checking accounts. In this case, we'll talk about option number one, maybe the bank not pay any interest if you open or request current or checking account. Another option or option number two, Some banks may be very little interest on the current or checking account. Another option or option number three, that may some banks cut or required fees to open current or checking account. So in this case, current or checking account, the majority of banks never pay or not pay any interest on this time. Time or savings deposits, in this case, the bank pay interest, and the time or saving deposits may be short run, maybe medium, maybe long run. So the interest paid by the bank may be fixed and may be variable. Fixed, yes, this is in the contract, in obligations for this contract, the bank will pay 10% for this time or saving deposit for 3 years, whatever the trend of the market interest rate. May be variable, the variable based on or take into account the modification on the interest rate. Yes, in our example in Egypt, the central bank encouraged the Bank Misr and the National Bank or Bank Al Ahli to issue the certificate of deposits with the interest rate 18% for 1 year. Category number three, we talk about the consumer loans and mortgage. Consumer loans used to maybe secured or unsecured. So in this case, unsecured, so there is no collateral or guarantee is requested. But secured, we will use an asset or property, and the interest rate are mainly variable. Okay. But what about the mortgage? Mortgage, when we talk about the bank provide mortgage products, okay, for purchase the property, buildings, flats, and so on. So the time of mortgage in Egypt, in UK first, in UK from 20 to 25 years. But recently in Egypt announced about mortgage loans up to 30 years. And what about the interest? The interest equals 3%, and the target group, middle and lower income groups. The next section will talk about some services like investment and the pension and insurance services. The investment products offered to retail clients, in this case, we talk about the investment like bonds, like shares, like mutual funds, and the stocks. In this case, for example, saving bonds, the the bank provide investment products to clients, and this is a relationship between saving and investment products to attract new customers, to target new sector. Pension services. In the pension services, in this case, we talk about the retirement income. The bank target retirement group, retirement individuals. Retirement equal when the individual age 60 or more. 60 or more. So contributions paid into the pension funds are invested in long-term projects. Okay, so what about the share? The shares of the pension funds divided by the members, and when the member go to retirement, in this case, obtain the retirement income. So this is private pensions to distinguish for the public. Private pensions, in this case, talk about the income provided by private sector like bank to the beneficiary. But the public pensions offered by the government, in this case, we talk about some advantage like tax advantage for this pension funds. Insurance services. Insurance services protect the individuals from various adverse events and risks. So in this case, suppose you get a loan from the bank, and maybe risk related to accident, related to death or illness, and so on. So the banks offer life and non-life insurance. So in this case, we talk about the developed countries. There is a significant growth in income protection insurance. Income protection insurance. So this is the measure for the bank to keep or to manage the risks. Payment protection insurance, or abbreviation, stands for PPI. PPI stands for the payment protection insurance, an insurance product provided by the bank to cover, to minimize any debt. Mainly, we focus on loan and overdraft. Loan or overdraft. Okay, the PPI provided by the bank to cover problems like accident, like unemployment, like death, like illness, and so on. So insurance, lender's mortgage insurance is insurance that protects the lender and usually one-time payment.